Welcome to the deep dive. So, what we do here is grab a bunch of sources, could be anything, articles, studies, notes, and we basically pull out the key stuff.
Yeah, figure out what really matters.
Exactly. Kind of a shortcut to getting up to speed. And today, we're taking a deep dive into something that, well, it affects absolutely everyone, the psychology of money.
Mm-hmm.
Our source material today is heavily inspired by a really, really insightful book on this topic.
That's a great one.
Yeah. So our mission really is to unpack these core ideas together, try to get why our behavior with money is, so much more important than we usually think.
Right. And how our own background shapes it all.
Totally. And the source kicks off with these two stories that just grab you immediately. First, you've got this high-flying exec, right, in a fancy hotel.
Okay.
Breaks a lamp, manager says it's $500. And the guy pulls out a huge wad of cash, throws $5,000 at him, and says, basically, get lost and don't insult me.
Wow. That's quite an attitude.
Yeah. And you got to wonder how long that lasts, right? The book just says, not long. He went broke.
Figures.
But then contrast that with Ronald Reed. Maybe you remember his name.
Vaguely. The janitor.
That's him. Janitor, gas station attendant, super modest life, first in his family to finish high school.
Right.
But when he died, this quiet guy had built up an $8 million fortune.
$8 million. Incredible.
And left most of it to charity.
And right there, just in those two stories, that's the absolute core idea the source gets at. Doing well with money. It's really not about how smart you are, not your IQ.
It's behavior.
It's your behavior, exactly. That exec, probably brilliant in his job, but his behavior. Total financial derailment.
Yeah.
Ronald Reed, no fancy finance degree, but consistent behavior, saving, investing patiently. That's what built the wealth.
And the tough part.
The tough part is that behavior is just incredibly hard to teach,
Well-
even to really, really smart people.
So it's not like physics.
Not at all. That's what the book argues. Physics has
So it
laws,
says.
right? H2O is water every time. Money, no way.
You can have two people, same smarts, same income, end up in wildly different places financially. Why? Because their behaviors, their emotions, their histories are different. It's all tangled up with feelings and beliefs.
Exactly. Psychology, not physics.
And that's really why this conversation matters for, you listening. Doesn't matter what your job is, how much you have right now. Money touches your life.
Absolutely.
Understanding these, hidden psychological forces, that's valuable for everyone.
So, okay, where does this behavior actually come from? A huge piece of it, maybe the biggest, is just your personal history.
Your own life experience.
Yeah. Everyone has this completely unique view of how the world works, especially money. And here's the kicker. What you've personally lived through. That's like a million times more convincing to you than anything you just read about or someone tells you.
That makes sense. It feels real.
Totally real. Think about it. Growing up poor versus growing up rich. Fundamentally different views on risk, on what's possible. Or experiencing, say, crazy high inflation when you're young versus living through times when prices are stable.
Yeah, totally different feel.
Or the Great Depression versus the dot-com boom. Or even just, being Australian where they haven't had a recession in forever versus being American and seeing several different realities.
It's almost like your own personal story, even if it's this infinitesimally tiny slice of world history.
Like 0.00000000001%? Yeah.
Right. That tiny slice makes up maybe, 80% of how you think the financial world actually operates?
That feels about right. And
Yeah.
it explains so much disagreement. You get two equally smart people looking at the exact same data,
Yeah.
and they come to completely opposite conclusions about what to do with their money. They're seeing it through totally different lenses.
Lenses shaped by their own lives?
Precisely. There's this great study the book mentions, Malmendier and Nagel. They looked at decades of data
Okay.
and found people's willingness to, take risks with investments.
Yeah.
It wasn't really tied to how smart they were or their education.
So what was it tied to?
Mostly the random luck of when and where they were born, what economic stuff they lived through personally.
Wow. Just life roulette.
Exactly. Like the book talks about Bill Gross, the big bond investor. He admitted his whole career lined up perfectly with interest rates falling for decades.
So bonds looked amazing to him.
Like wealth-generating machines, yeah. But his dad's generation, they saw inflation eat up savings. Bonds might have felt more like wealth incinerators to them,
Same asset, totally different experience.
based purely on when you lived.
That makes so much sense. You even see it just with inflation, right? If you were born in, say, 1960 in the U.S.
Prices basically tripled while you were growing up.
Yeah, you remember that feeling. But born in 1990, your whole adult life is low inflation. It's just normal.
Completely different lived reality. And the book points out how national averages hide these massive gaps, too. Like, November 2009, U.S. unemployment, 10%.
Pretty bad.
But for young black men without a high school diploma, it was nearly 50%.
50.
Wow. And for, say, older white women with college degrees, 4%. Totally different worlds. Same country, same time.
And those different worlds must drive different behaviors. Things that look weird from the outside.
Oh, absolutely. Take lottery tickets.
Yeah.
Americans spend more on lotto than, like, movies, games, music, sports, and books combined.
That's crazy. Who's buying them?
Mostly people with lower incomes, spending maybe hundreds a year. And you look at that, especially knowing, 40% of Americans can't cover a $400 emergency.
Seems completely irrational.
From a certain perspective, yeah.
Yeah.
But the book says, try to see it from their side. Maybe saving feels impossible. Maybe raises aren't happening. They can't afford the stuff higher income folks take for granted.
Right. Vacations, reliable cars.
Exactly. So that lottery ticket, yeah, the odds are terrible. But maybe it's the only way they can hold on to a tangible dream of getting that good stuff instantly.
So they're buying hope.
In a way, yeah.
Yeah.
Buying a dream that others already live in. It might seem crazy, but it makes a certain kind of sense from within that reality.
That's a powerful way to think about it. It really shows how these decisions aren't just numbers on a spreadsheet.
Not at all.
They're made at the kitchen table, right?
Yeah.
Full of history, ego, pride, your own unique way of seeing things.
What seems nuts to one person makes perfect, if maybe sad, sense to another based on their story.
Okay, so shifting gears a bit, but related to these changing realities, you also point out that a lot of financial stuff we take for granted is actually super new.
Oh, incredibly new. The whole idea that you're somehow entitled to retire comfortably, that's maybe, 2 generations old, max?
Really? Before World War II?
Pretty much everyone worked until they dropped
Mm-hmm.
or died. That was just normal.
Wow. So Social Security changed things.
It started to, but the initial benefits were tiny. Like less than $1,000 a month in today's money until the 80s.
And pensions weren't common either.
Nope. In 75, only about a quarter of seniors had any pension income. And it was only like 15% of their money. There's a quote from a 1955 newspaper article in the source.
Yeah.
Something like, everyone talks about retirement, but apparently very few do anything about it.
And the tools we rely on now, 401k.
Didn't even exist until 1978.
And Roth IRAs.
1998. These things are younger than a lot of people listening right now.
That's actually mind-blowing when you think about it.
It is. So this whole expectation that everyone's going to save diligently for decades to fund 20 or 30 years of leisure, that's a really recent kind of revolutionary idea, not some ancient tradition.
That context really changes how you see the pressure to save for retirement. It's a new system, really.
A very new experiment in many ways.
Okay, so let's talk about something else that really trips people up.
Yeah.
Trying to figure out what's luck and what's skill.
Oh, yeah, that's a tough one. Incredibly hard. The source brings up Ken Evans, Bill Gates' early partner.
Yeah, right.
By all accounts, just as smart, just as driven, but life took them on different paths, partly due to stuff completely out of their control.
That life roulette again.
Exactly.
Right.
And we humans, we don't really like talking about luck, do we?
Not really. It feels weird.
Yeah, admitting your own success had luck involved feels like you're downplaying your effort. And acknowledging someone else's luck can sound like you're jealous or diminishing their hard work.
True.
There's a study by Bhaskar Mazumdar mentioned. He found brothers' incomes are more correlated than their height or weight.
Whoa. Meaning family background, socioeconomic status matters a lot.
Hugely. But the funny thing the book notes, rich brothers rarely think that correlation applies to them.
Of course not. And it's also hard to know after the fact if a bad outcome was your fault or just risk showing up.
Totally. You make a bet with an 80% chance of winning and it loses. Was it a bad decision or did you just land in the unlucky 20%?
Hard to tell. We like simpler stories. Bad outcome, bad decision.
Right. And we also try to learn from the superstars,
Mm-hmm.
like Cornelius Vanderbilt or Benjamin Graham.
The legends.
Yeah. But Vanderbilt basically ignored laws left and right. And Graham, his massive success largely came from one huge bet on JICO.
Which actually broke his own rules about diversification.
Exactly. So where's the line between bold and reckless when luck is such a huge factor? Graham himself wasn't even sure if JICO was brilliant insight or just a lucky break.
So maybe trying to copy the absolute outliers isn't the most useful strategy?
The book argues it's probably more actionable to look for broader patterns, what works and doesn't work for lots of people. The average experience might be more instructive.
Like, don't try to be the next Warren Buffett necessarily.
Right. His real secret isn't just stock picking, it's time. He's been compounding for decades. That endurance.
Which kind of leads back to that Bill Gates quote.
Oh, yeah. Success is a lousy teacher. It seduces smart people into thinking they can't lose.
So when things are going well,
Remember, you're not invincible. Luck probably helped you get there. And luck has a cousin called risk, and it can bite you just as easily.
the key takeaway being
Nothing is as good or as bad as it seems. Keep some humility.
humility. And maybe knowing when you have enough. That seems related. Let's talk about enough. That Joseph Heller story is amazing.
Oh, the Catch-22 author. At the billionaire's party.
Yeah. Kurt Vonnegut points out the host made more in one day than Heller's book made, like ever.
And Heller's response?
Eh.
Perfect.
Yes, but I have something he will never have.
Down to rudder.
Mmm.
Just brilliant. Because you see the opposite constantly.
Like Rajat Gupta.
Exactly. Former CEO McKinsey. Worth maybe $100 million. That kind of money makes money while you sleep. Hundreds an hour.
And yet,
He risked it all, his reputation, his freedom, everything, chasing more through insider trading. Ended up in prison.
it's crazy. It reminds me of that Buffett quote about long-term capital management.
To make money they didn't have and didn't need, they risked what they did have and did need. And that's foolish.
Spot on.
So that's a core principle then.
Absolutely fundamental from the source. There is no reason to risk what you have and need for what you don't have and don't need.
Seems obvious, but hard to follow. Because most people, if they have a decent career, will earn enough for their needs and a lot of their wants. The real skill isn't making infinite money, it's knowing when you actually have enough.
And that seems like the hardest financial skill there is, getting the goalpost to just stop moving.
It really is.
Yeah.
Because if you can't define enough or you keep pushing it further away, that chase for more,
Yeah.
it eventually catches up to you. Leads to ruin sometimes.
Because you end up risking things you shouldn't.
Exactly. Things that no amount of extra money is worth. The book lists them out. Reputation, freedom, independence, family, friends, being loved by those who matter, happiness itself.
Yeah. Invaluable.
Knowing when you have enough is your best defense for keeping those things safe.
Okay, so keeping things safe, that leads to another really big idea in the book, survival.
Yes. If you had to boil down financial success to one word, the book argues it's survival.
Why survival?
Because of compounding. That magic where money makes money, which makes more money, it only works if you give it a long time.
And to be around for a long time.
You have to survive the bumps, the downturns, the crises, the unpredictable stuff. The book notes something startling. 40% of public companies eventually lose basically all their value.
Wow. So just not going bust is a major achievement.
It really is. Survival is underrated.
It reminds me of that quote from Michael Moritz at Sequoia Capital, the VC firm.
Oh, yeah.
He said their success came from longevity, from always being paranoid they were about to fail. Only the paranoid survive. They didn't take game-ending risks.
That's exactly it.
Yeah.
Look at Buffett again. His genius isn't just picking winners. It's also not doing the dumb things that would have knocked him out of the game over the last 60 years.
Endurance through survival.
That's the foundation.
And the book has this surprising example about how survival works. Holding cash.
Seems totally irrational on paper, right?
Yeah.
Cash earns almost nothing compared to stocks.
Yeah, why hold it?
But if having that cash buffer prevents you from being forced to sell your stocks or your house at the absolute worst time during a panic when you lose your job,
Oh.
then the real return on that cash isn't the tiny interest rate. It's potentially enormous. It's the devastating loss you avoided. It keeps you in the game.
So it prevents that one catastrophic mistake that could wipe out decades of compounding.
Exactly. Compounding needs good returns, yes, but more importantly, it needs uninterrupted returns. Survival provides the interruption insurance.
Okay, so survival requires planning for, well, for things going wrong, planning for uncertainty.
Right, and that means building in room for error. You know the saying, you plan, God laughs.
True.
Financial plans are good, they keep you grounded. But let's be real, almost no plan survives reality untouched. You absolutely have to plan on the plan not going according to plan.
I mean, just look at the last 20 years.
Seriously. 9/11, housing crash, financial crisis, huge bull market, a global pandemic.
Yeah.
Who writing a 20-year plan in the year 2000 could have possibly factored all that in? No one.
So a good plan isn't about predicting the future perfectly.
Not at all. It's about acknowledging you can't predict it and building in a buffer, a margin of safety, room for error.
Like what? Give me an example.
Like being okay financially if the stock market only gives you, say, 4% year for the next 30 years, instead of needing it to give you 8% or 10% for your plan to work.
So less optimism, more cushion.
Exactly. The more your plan needs specific rosy things to happen, the more fragile your whole financial life becomes.
It's like professional blackjack players counting cards.
That's a great analogy from the book. They know they have an edge, odds are in their favor over time, but they also know they can lose badly in the short term.
Right, streaks of bad luck.
So how do they survive those? By having a big enough bankroll? They talk about needing 100 basic units, whatever.
Yeah.
They never bet everything, no matter how good the odds seem.
You're never so right you can bet the farm.
Never.
And that room for error, that buffer, it's not just defensive, right? It's actually strategic.
Totally strategic. It buys you endurance. It lets you stick around long enough for the good stuff. The really big, low probability wins the tail events to potentially happen for you.
Like catching a huge market upswing or the benefit of some new technology.
Exactly. If you get wiped out because your plan was too tight, too optimistic, you miss all of that upside. Game over.
Yeah.
The buffer keeps you in the game to potentially catch those tails.
Which connects back to just saving, even without a specific goal.
Yes. Saving just for saving's sake. It's the ultimate buffer. It's your hedge against life, inevitably throwing you curveballs when you least expect it. It's building that room for error into your life.
So what does all this, the survival, the saving, the room for error, what does it ultimately get you?
Well, the book makes a really beautiful point here. It argues the highest dividend money pays. The ultimate goal, maybe, is control over your time.
Control over time.
Yeah, the ability to do what you want, when you want, with who you want, for as long as you want. That freedom, that autonomy. That's priceless.
More valuable than fancy stuff.
Way more valuable,
Mhm.
according to research by psychologist Angus Campbell. He found happiness isn't just tied to income or where you live, but using money to buy yourself flexibility and control over your daily life. That has a huge impact on well-being.
Fewer luxury goods can compete with that feeling of independence.
Right.
The author shares his own story about that, right? The investment banking internship.
Yeah, he thought the high pay would make him happy. He actually liked the work, the intellectual challenge. But the hours were insane. No control. Mandatory weekends. He was miserable because he had zero autonomy over his time. He quit after a month.
Wow. And he contrasts that with the musician Dave Severs.
Who said having just $12,000 in savings was life-changing. Not the amount itself, but because it was enough to quit his job and gain independence, he could just play a few gigs a month.
So that small amount bought him immense control over his time, his most valuable asset.
Exactly. There's a psychological term for that feeling when you lack control. Reactance.
Reactant.
Yeah, it's that fundamental need we have to feel like we're in the driver's seat. Even if you like doing something, being forced to do it on someone else's schedule, it feels bad, disempowering.
It's interesting, you look at the U.S. wealthiest country, arguably.
Historically, yeah.
But Gallup polls consistently show Americans report higher levels of worry and stress than the global average.
That's a paradox, isn't it? We have the money, but maybe not the peace of mind that comes with control.
Maybe we're chasing the wrong things.
Could be. The book mentions another poll, asking 1,000 people what makes them happy.
And the answers.
Not a single person mentioned making tons of money or buying stuff or being richer than the neighbors or picking a job just for the paycheck.
So what did they value?
Friendships, belonging, time with their kids, the real human stuff. Money can help enable those things for sure, but it's not the end goal itself. Control over your time definitely helps nurture those connections.
Okay, and speaking of what money is, here's another paradox the book digs into. Real wealth is what you don't see.
Yes, this is a big one. We tend to think rich means visible spending.
Right. Fancy cars, huge houses, designer clothes. You see that.
You see their spending, which often reflects high income, not necessarily high wealth. The valet parking example is perfect.
Seeing the Ferrari pull up.
Your first thought is, wow, rich person. But the author realized, watching them, many were maybe just mediocre successes, spending a huge chunk of their income to look rich.
It reminds me of that quote, Bill Mann.
Yeah. Feeling rich is spending money you have. Being rich is not spending money you have.
Okay, unpack that. Rich versus wealthy.
Rich is often about current income, high cash flow, and the spending that goes with it. It's visible. Wealthy is about The accumulated assets, the savings, the investments, the money you haven't spent, it's often invisible,
And not knowing that difference.
is a major source of bad financial decisions. People try to mimic the visible spending of the rich, thinking that's the goal, and end up with no actual wealth.
So, okay, if wealth is the money you don't spend, what good is it? Why just let it sit there?
Because it buys you things more valuable than stuff. It buys you control, options, flexibility, independence, that room for error we talked about, that survival buffer.
Ah, okay, it's the unseen foundation.
Exactly. And that's why saving, even without a specific purchase in mind, is so incredibly powerful. Building wealth often depends less on your income or investment genius and more on your savings rate.
The percentage you manage to not spend.
Right. It's like the energy analogy in the book. After the 70s oil crisis, the U.S. got more energy wealthy, not just by finding more oil, but mainly by becoming way more efficient, using less energy for the same output.
And efficiency, like your savings rate.
Is something you can actually control much more than your investment returns or your income sometimes. Saving is your personal form of efficiency.
So just saving buys you that control, those options. It's wealth itself.
Precisely. Which leads us nicely into how we actually make these decisions. Because we're not calculators.
Definitely not. We're emotional messes sometimes.
Oh, exactly. We're human.
Uh,
So financial decisions are rarely purely rational, based only on the cold, hard numbers, the optimal mathematical outcome.
They're usually.
They're usually reasonable, based on what makes sense in the real world, considering our emotions, our social situation, our personal quirks.
Okay, give me an example.
The book uses this wild, historical one. Julius Wagner Jauregg won a Nobel Prize for treating syphilis by giving people malaria
What? Why?
to induce high fevers, which apparently had some statistical benefit against syphilis. Rationally. Okay, maybe the data showed a slight edge against a killer disease.
But reasonably.
It was torture, agonizingly painful. People avoided it if they possibly could. Just like we all pop Tylenol for a fever, even if the fever itself might be helping fight infection, because fevers feel awful. That's reasonable.
Okay, got it. So how does that apply to finance?
We don't make decisions based purely on spreadsheets. Think about Harry Markowitz, the guy who
Right.
invented modern portfolio theory, all that math.
Yeah. Nobel Prize winner.
When investing his own retirement money, he just split it 50-50 between stocks and bonds. Why? He said it was to minimize his future regret.
Not maximize returns.
Nope. Minimize the emotional pain of being wrong, either missing a rally or getting crushed in a crash. That's a reasonable human decision, not a purely rational one.
And using tons of leverage.
Right. Rationally, on paper, leverage can boost returns. But if you've ever been wiped out by it, it becomes completely unreasonable to ever do it again. And investing isn't done in a vacuum, right? You talk to your spouse, your friends, your coworkers,
Social factors matter.
hugely. So the book argues that making reasonable decisions is often better than striving for pure rationality, because reasonable decisions are the ones you can stick with. They allow for endurance.
Like what kind of reasonable decision?
Like maybe having a home bias, investing mostly in your own country's stocks. Not perfectly rational from a global diversification view, but maybe reasonable if that familiarity helps you not panic sell during a crisis. Or maybe doing a tiny bit of day trading or stock picking on the side. Rationally, the odds aren't great for the effort involved. But maybe reasonably, it scratches an itch, makes finance feel engaging, and keeps you from messing with your main sensible portfolio.
So it serves a psychological purpose.
Exactly. Even making forecasts. We know most are wrong, but it feels human, reasonable to try and anticipate the future. Or Jack Bogle, Mr. Index Fund himself, investing some money in his son's higher fee active fund. Not rational by his own rules, but understandable, reasonable on a human level.
And that endurance, sticking with a reasonable strategy, that's key for long-term results.
Massively correlated. The odds of making money in the stock market just go up dramatically the longer you stay invested, like 50-50 on any given day, but pretty close to 100% over any 20-year period historically.
So finding an approach you can live with that lets you endure the ups and downs.
That's often more important than finding the theoretically perfect, rational strategy that you bail on at the first sign of trouble. Endurance puts the odds in your favor.
Okay, but speaking of history and odds, we also need to be careful about relying too much on the past, right?
Oh, absolutely crucial point. History is invaluable for calibrating expectations, for seeing the range of what can happen. But it is definitely not a map of the future.
The historians as prophets fallacy.
Exactly. Maybe in geology, history is a great guide because the underlying processes are stable. But the economy, investing, things change. Innovation happens. structures shift.
Like those tail events you mentioned.
Right. Think about the 20th century. The Great Depression, World War II, vaccines, the internet, 9/11, the fall of the Soviet Union. These huge, often unpredictable events drove outcomes way more than billions of ordinary days.
And they connect in weird ways.
Totally unforeseen ways. The book traces that chain. 9/11, Fed cuts rates,
Yeah.
housing bubble, financial crisis, bad job market, more people go to college, student debt crisis. Who saw that coming?
Nobody. It reminds me of that Daniel Kahneman quote.
The lesson from being surprised is that the world is surprising. That's it. The future won't look just like the past because surprising things happen and the system itself changes.
What kind of structural changes?
Oh, we talked about 401ks and Roth IRAs being new.
Mm-hmm.
Venture capital is a major force, barely existed 25 years ago. Phil Knight from Nike talked about how hard it was to get funding back then.
So historical data on startup funding is kind of useless now?
Largely, yeah.
Yeah.
The whole system is different. Or think about Benjamin Graham's value investing formulas. Brilliant for their time, but less effective as markets changed, technology evolved, industry shifted. Relying only on old data ignores today's reality.
So that famous phrase, "it's different this time," it's usually mocked as dangerous thinking in investing.
Right. John Templeton called it the four most dangerous words.
Right.
Because often it isn't different, it's just wishful thinking.
Right.
But Templeton himself admitted, maybe 20% of the time, it is different. Change is constant. Michael Batnick had that funny counter quote.
What was it?
The 12 most dangerous words in investing are, the four most dangerous words in investing are, it's different this time.
Huh. So ignoring change is the real danger.
Exactly. Because things do change.
And one of the biggest things that changes is us, you, the listener.
Yes. The end of history illusion. Psychologists found we consistently underestimate how much our own values, goals, desires, even our personality will change in the future.
We think we're pretty much done evolving, but we're not.
Nope. We look back and see how much we've changed, but we don't project that same amount of change forward.
You see it all the time, right? Someone picks a college major dead set on a career.
And ends up doing something totally different 10 years later. Or the lawyer works crazy hours, then becomes a stay-at-home parent, then faces retirement, realizing their savings plan didn't account for that shift.
Our lives rarely follow the straight path we imagine when we're young. Only like a quarter of grads work in their major field.
Right. And this is a huge challenge for long-term planning. Compounding in finance, careers, relationships works best with endurance, sticking with something. But if we keep changing, that endurance gets tricky.
So how do you handle that? Planning for a future self you don't even know yet.
The book suggests a couple of things. One is avoiding extreme life plans. Don't lock yourself into something that requires scraping by on minimum wage forever, and don't lock yourself into a soul-crushing 80-hour-a-week job just for maximum income.
Why avoid the extremes?
Because the initial thrill or justification wears off. We adapt. But the downsides, poverty in old age or deep regret over missing your kids growing up, those can become permanent burdens for your future, changed self.
So aim for balance.
Balance at every stage seems key. Moderate savings rate, decent amount of free time, a manageable commute, time for people you care about. That balance makes it easier to endure as your priorities shift over time. Less chance of future you looking back with massive regret.
And related to regret, sunk costs. Letting past efforts dictate future choices.
Ugh, yes, a huge trap. Jason Zweig tells that great story about watching Daniel Kahneman just toss out months of work on a book draft.
How could he do that?
Zweig asked him, and Kahneman just shrugged and said, I have no sunk costs. Meaning the past effort was irrelevant to the decision of whether the draft was good now.
That takes discipline.
It does.
Yeah.
Because sunk costs make your future self a prisoner of decisions made by your past self who might have been a very different person with different information or goals.
So the advice is,
Be willing to ruthlessly abandon projects, goals, even paths that were set by that different person, your past self, if they no longer make sense for who you are now or who you're becoming. It's about minimizing future regret, not justifying past effort.
okay, wow, we've covered a ton. Personal history, luck, enough, survival, room for error, reasonable choices, navigating change. As we start to pull this together, let's talk about the actual cost of success, especially in investing.
Right. Because it looks easy on paper sometimes, doesn't it? Just buy good stocks and hold them.
Yeah, sounds simple.
But that simple advice comes with a hidden price tag. It's not just the dollars you invest. The price is also the volatility, the fear, the doubt, the uncertainty, the regret you feel along the
The
way.
emotional roller coaster.
Exactly. And it's easy to ignore that price until you're actually riding the roller coaster, plunging downwards.
So trying to get the long-term rewards without experiencing the bumps.
Is like trying to steal the car instead of paying for it.
Yeah.
It rarely works out well in the end. The book uses these amazing examples: Netflix, Monster Beverage,
Huge winners, right? Astronomical returns over decades.
absolutely life-changing returns.
Yeah.
But guess what percentage of the time those stocks traded below their previous all-time high?
I dread to ask.
94 to 95% of the
Yeah.
time.
Whoa. So almost always, holding them felt like you were losing money relative to the peak.
Precisely. To get those massive long-term gains, you had to endure years of feeling like you were behind, years of gut-wrenching drawdowns. That volatility, that uncertainty, that feeling, that was the fee, the price of admission.
And trying to avoid that price.
Often leads to paying an even bigger price later.
Yeah.
Think about companies that try to smooth their earnings to look less volatile, like GE under Jack Welch, or Freddie Mac and Fannie Mae back in the day.
Yeah, they got in trouble.
Big trouble. By trying to dodge the normal, everyday price of market volatility, they ended up manipulating things and paying a much heavier price through scandals and crises. They paid double.
So the trick is,
To reframe how you see volatility and uncertainty, don't see it as something bad you should try to avoid. See it as a fee, a necessary cost you willingly pay to get access to the potential for higher long-term returns.
like paying tuition for market gains.
Kinda, yeah. If you see it as a fine, you'll try to get out when it feels uncomfortable, and you'll likely miss the magic of compounding. You have to find the price, understand it's part of the deal, and be willing to pay it.
Man, there are just so many powerful, counterintuitive ideas here. Let's try to quickly stitch together some of the biggest takeaways.
Sounds good.
Okay, first, respect luck and risk. Focus on what you control, your behavior, your savings, and less ego equals more wealth, right? Wealth is that gap between income and ego.
Definitely. And save. Save just for the sake of saving. It's your buffer, your hedge against surprises. It buys you flexibility.
Right. And understand success has a price, especially in investing. That volatility, it's the fee, not a fine. Know it, expect it, pay it.
And worship room for error. Margin of safety in everything. That buffer gives you the endurance needed for compounding to work its magic over years and decades.
Yeah, endurance is key. And avoid extremes in your financial life. Balance moderate savings, free time, reasonable work helps you endure as you inevitably change over time. Minimizes future regret.
And you know, the author really lives these principles. He shares personal examples. His parents, even after his dad became a doctor, kept expenses low, saved aggressively. That gave his dad the freedom, the independence, to eventually leave a high-stress ER job he hated.
He bought back his time.
Exactly. And the author himself, choosing to own his house outright, keeping a lot of assets in cash. On a spreadsheet, maybe that looks irrational, not maximizing returns.
But for him.
It provides independence, peace of mind. It helps him sleep at night. It's reasonable for him. It prioritizes his happiness and endurance over being technically right, according to some formula. And the book argues those kinds of personal, sometimes unreasonable choices are often the best ones if they help you stick with it and achieve the independence you value.
That really brings it full circle.
And maybe just one final piece of context.
Yeah.
Understanding how we got to our current financial place, especially in the U.S., helps explain some behavior.
Like the high debt levels.
Yeah. The book quickly traces how, post-WWWI, the goal was avoiding another depression. So encourage spending, keep interest rates low, boost productivity. And it worked for a while.
Incomes rose pretty evenly.
From about 1945 to 1973, yeah. Average wages doubled and doubled again. The gap between rich and poor actually narrowed. There was this sense of lifestyle equalization. The differences between classes felt smaller, more bridgeable. A regular person drove a Chevy, a rich person, a Cadillac. You could kind of fathom the difference. Mass media created shared aspirations.
But then things changed.
Starting in the 70s, yeah. Growth continued, but it got really uneven. Skewed massively towards the top 1%. But those aspirations, that idea of the broadly shared middle-class lifestyle, that stuck around.
So people still wanted that life, even if incomes weren't keeping up across the board.
Exactly. And how did many try to bridge that gap between expectations and reality?
Debt.
Massive increases in household debt.
Right.
Mortgages, cars, college, especially concentrated in lower and middle income groups, trying to stretch for that lifestyle perceived as normal.
So expectations move slower than the economic reality.
That's a great way to put it. That post-war expectation of a shared, attainable middle-class life persisted even as inequality widened, leading to debt to fill the gap. Just shows how powerful those historical expectations can be.
Wow. This whole deep dive, it really hammers home that understanding the psychology, the behavior, the history behind our money decisions, it's maybe more important than just knowing the mechanics.
I think it absolutely is. It's about recognizing these powerful, often hidden forces, our personal stories, our expectations, our tolerance for risk, our need for control, and how they shape everything we do with money.
Yeah.
And maybe a final thought for everyone listening. Think of money as this incredible magnifying glass on human behavior. Take a moment. Really reflect honestly on your own unique personal history.
The times you grew up in, family stories, your own wins and losses.
Exactly. How have all those things genuinely shaped your deepest beliefs and habits around money? And then ask yourself, are those ingrained views actually serving you today? Are they helping you move towards the independence, the control, the happiness you really want?
That is definitely something worth pondering. Thank you so much for joining us on this deep dive. We really hope it's given you some valuable new perspectives on your own financial life.